monetary policy in Japan doesn't have much power to push inflation up or to drive the economy. And I think fiscal policy is really the game in Japan at the moment that's going to drive activity.
So monetary policy, this extraordinary stimulus, extraordinary negative rates, extraordinary pumping in of money has failed, or it's done all it can and now it's about fiscal from that foundation?
I think it's about fiscal. I think, monetary policy, we've had super easy policy for years and years and years. And we did have, when Abe-san came in, the shift in monetary policy that drove the exchange rate down, did drive inflation up. But that inflation hurt workers and pensioners. And essentially in 2015, I think the Bank of Japan took its foot off the gas.
So can I just actually say, if you were to tweak rates to the upside, would that have the effect of helping out those workers, helping out those pension funds, and actually increasing consumption?
Well, it could do that, but it would also hurt manufacturers. They would be crying to Mr. Abe. I think if we saw any change in Japanese rates, it would be a change in policy regime, and therefore you'd have a disproportionate effect on the exchange rate. I think that the same is true of the ECB. When the ECB's been talking about getting rid of negative rates, even if they changed it by 1 basis point, the shift would say, we've shifted monetary regime, we're now in a tightening mode. You get a very big appreciation of the exchange rate. And that's why I think it'd be very unwise for them to move the deposit rate anytime soon.
We've just come through a fairly strong time for markets and also for animal spirits. But I think if you look at some of the expectations, for me what was starting around yesterday, PIMCO was changing some of their expectations on the US core inflation forecast. And they were one of the market that was quite strong on the amount of interest rate hikes stateside this year. They've reversed back from 2.3 to 2%. I wonder whether, if you circle across to Japan, the United States and to Europe, that inflation expectations might underwhelm this year rather than overwhelming like the market had anticipated a couple of months ago.
Yeah, I think the market was kind of assuming that inflation was a more dynamic process than it really is. I think inflation doesn't really respond very much anymore to the real economy and falling unemployment. And I think what we've seen in the States is a couple of big relative price changes, microeconomic changes. The bringing in by the biggest mobile phone operators of unlimited data bundles has knocked more than 0.1% off overall inflation. The fact that tons of cars are coming off lease, so you've got a glut of second-hand cars on the market, is driving down car prices. Now, is this inflation or is it a relative price change?